If you're an investor in YZJ Financial, or if you have been tracking the Singapore market this week, you probably saw the headline and felt your heart skip a beat. A 51% drop. When you open your brokerage app and see a stock down by more than half in a single trading session, the immediate visceral reaction is panic. It looks like a catastrophe. It looks like a business failure. And if you look at the broader tech sector, specifically NIO, you saw a 12% pullback despite them delivering record numbers. It feels like the market is broken or that the floor is falling out from under these names. But if you strip away the one-offs and the accounting adjustments, the real story is completely different. That 51% drop in YZJ isn't a loss of value, it is a restructuring of value. And the volatility we are seeing in NIO isn't about business failure, it is about a fundamental disconnect between operations and sentiment. In fact, while these headlines are grabbing attention, the real story is happening quietly in the background, with the banking sector pushing the Straits Times index to fresh all-time highs above 4,540 points. This is a complex week where the red numbers on your screen are lying to you and the green numbers might be hiding concentration risks. I am Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the sensationalist headlines, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, point-by-point analysis through the wildest week on the SGX we have seen in months. First, let's address the elephant in the room. We have to talk about YZJ Financial. If you held this stock, you saw it crash a staggering 51% this week. But do not panic, this was not a business meltdown. This is what we call a corporate action illusion. To understand this, we need to define what an ex-entitlement event actually is. In the context of YZJ, the company is spinning off a new entity called YZJ Maritime. This new company is going to list separately on the Singapore Exchange. Here is how the math works. Shareholders receive YZJ Maritime shares on a one-for-one basis. This means for every share of YZJ Financial you held, you now own one share of the original company and one share of the new maritime entity. The value wasn't destroyed, it was redistributed. The market automatically adjusted the price of the parent company down to reflect that the maritime assets have been removed and given to you separately. The ex-entitlement event happened on Monday, and the new maritime business lists on November 18th. Why does this matter for you? Because corporate spin-offs often confuse retail investors who see a massive red number and assume disaster. Let me be clear, YZJ Financial's 51% drop is accounting mechanics, not value destruction. You now own two separate entities instead of one combined company. The strategic logic here is something called sum of the parts valuation. The theory is that by separating the financial investment business from the maritime fund and vessel investment business, the market can price each one more efficiently. Early indications suggest YZJ Maritime will focus on its maritime fund, while YZJ Financial pivots more aggressively into new financial ventures. However, from my perspective as an analyst, this creates a period of extreme volatility. The market is currently trying to figure out the fair price for each piece independently. If you are a long-term holder, this spin-off could unlock value if both entities execute well. But if you are just looking at the price chart, you are missing the picture. If you are using CPF funds, you also need to be careful. You need to verify that both new entities meet CPF eligibility requirements. Do not assume you can just hold both in your CPF account indefinitely without checking the new status. Now, let's shift gears to the winners, because while YZJ was grabbing headlines, the real money was being made in the banking sector. The Straits Times index climbed over 1.2% to hit fresh all-time highs, and it was entirely carried by the banking heavyweights. DBS and OCBC both posted record highs following strong third-quarter earnings. Let's break down why this is happening. We need to look at a metric called net interest margin, or NIM, combined with wealth management fees. For a long time, The fear was that as the US Federal Reserve cuts rates, the bank's margins would collapse. But that hasn't happened yet. Instead, we are seeing a surge in wealth management fees. This reinforces a structural thesis I have held for a long time. Singapore is cementing its position as Asia's wealth management hub. The money flowing into Singapore from across the region is finding its way into the coffers of our local banks. However, here is my perspective on the risk. The three local banks now command over 50% weighting in the STI. This is a massive concentration risk. If you are a passive investor in the index, or if your portfolio is just the three banks, you are effectively making a leveraged bet on a single sector. While the higher for longer interest rate environment has been a tailwind, the Federal Reserve's December decision is looming. Any signal of aggressive cutting could reverse this trend quickly. So, while we celebrate the all-time highs, we must acknowledge that our market is becoming incredibly top-heavy. Next, let's look at a specific mover that bucked the trend. Food Empire. This stock surged an impressive 13% this week. Why? They delivered blockbuster third quarter results that caught the market completely off guard. They posted revenue of $152.6 million for the quarter, which is a robust 28.3% year-over-year increase. Let's analyze the driver here. It is geographical expansion. Specifically, they are pushing aggressively into European markets, Russia, and the CIS regions. For the 9-month period, revenue climbed nearly 24%. This illustrates a key concept for Singapore investors: geographical diversification. Food Empire is a Singapore-listed company, but its fortunes are not tied to the Singapore economy. It is a play on emerging market consumption. But here is the Iggy perspective. While a 28% revenue jump is impressive, we need to look at the quality of that revenue. Operating in Russia and CIS regions comes with significant currency risk and geopolitical risk. These are volatile markets. A 13% weekly pop is exciting, but it also invites profit taking. If you are a new buyer looking at this chart, you have to ask yourself if you are chasing momentum or buying value. The stock has rallied hard. For existing holders, taking some chips off the table after a 13% move isn't being bearish. It is being smart. You don't want to be the one holding the bag if the ruble swings or if geopolitical tensions flare up again. Moving on to a steady performer, we saw Genting Singapore climb 6%. This is a classic recovery play. The thesis here is simple: tourism recovery. Genting is benefiting from steady demand for its integrated resort offerings at Resorts World Sentosa. Third quarter results showed a meaningful recovery in both mass gaming and non-gaming segments. When we analyze Genting, we are looking at a different type of stock compared to Food Empire. Genting is effectively a government-sanctioned duopoly. The barriers to entry are almost infinite. You cannot just open a rival casino in Singapore. This gives them a moat. The 6% gain is solid but not spectacular, and that is exactly what we expect. This is a steady grinder. My assessment for Genting is that it represents a play on stability. It generates strong cash flows, making it a favorite for dividend investors. However, the valuation is not cheap. It trades at a premium because everyone knows it is a safe harbor. The risk here isn't the business failing, it's the growth slowing down. If Chinese tourist arrivals plateau, or if regional travel gets disrupted, that premium valuation will contract. For SRS investors, this offers decent yields and capital stability. But do not expect it to double in price overnight. It is a mature business in a regulated industry where the upside is capped. Finally, we have to discuss the heartbreak of the week: NIO. The Singapore-listed shares of the Chinese EV maker pulled back 12%. And this is the most confusing part for many of you because the operational numbers were incredible. NIO delivered a record 40,397 vehicles last month. That is a massive 92.6% year-over-year increase. So we have to define the disconnect. Why does a stock drop 12% when it nearly doubles its sales volume? The answer lies in two concepts: margin pressure and cash burn. Delivering 40,000 vehicles is a genuine achievement, but volume without profitability is just burning cash with style. The Chinese EV market is currently in a brutal price war. You have BYD dominating the lower end and Tesla squeezing the top. NIO sits in an uncomfortable middle ground. Furthermore, there is a specific headwind for us here in Singapore. There is ongoing scrutiny following a lawsuit involving Singapore's Sovereign Wealth Fund, GIC, alleging revenue inflation. Whether these allegations hold water or not, markets hate uncertainty. The stock's retreat reflects a fear that the path to profitability is getting longer, not shorter. My take on NIO is that it epitomizes high risk, high reward. This is not a stock for your CPF. This is not a stock for money you need next year. It is a venture capital style bet. If you believe in the long-term EV transition and you can stomach 10 to 15% weekly swings, then a small position might make sense. But right now, the market is telling us that it values safety and profits like the banks over growth and cash burn. So let's bring this all together into a clear assessment. What is working right now? The old economy is working. The banks are a fortress generating record fees. The consumer staples like food empire are working, proving that people still drink coffee even in geopolitical hotspots. The tourism trade via Genting is working. What is not working? Complexity and unprofitability. The market punished NIO despite the volume because it doesn't see the profit. And the market created massive volatility in YZJ because it hates the confusion of spin-offs. Regarding valuation, the Straits Times index is at an all-time high. This usually signals caution. However, compared to the S&P 500, our banks are still trading at reasonable valuations with very attractive dividend yields. We are not in a bubble, but we are in a crowded trade. Here is my final recommendation. For existing unit holders of the banks, DBS, OCBC, UOB, hold. The yield is decent and the momentum is with you. However, if these banks now make up more than 40 or 50% of your portfolio due to the recent rally, consider trimming. Rebalance into other sectors. Do not let your financial future ride on a single sector. For existing shareholders of YZJ, hold. Do not sell into the panic of the 51% drop. Wait for YZJ Maritime to list on November 18th. Let the market find the price. You likely own more value than the current screen suggests. For new buyers looking at NIO, wait, the risk reward isn't there yet. The technicals are broken and the sentiment is too negative. I would wait for the price to stabilize and for clarity on the legal issues before trying to catch this falling knife. For new buyers looking at food empire, be careful. I would not buy immediately after a 13% spike. Wait for a pullback. The geopolitical risks are real and you want a margin of safety. This week has taught us that corporate actions rule the day and that understanding the mechanics is the only way to prevent panic selling. We also learned that geographical diversification cuts both ways. It helped food empire but hurt NIO. If you found this breakdown valuable and you want to stay ahead of these complex market moves, consider becoming a free or paid subscriber to the Investing Iguana Substack. We go even deeper into the numbers there. You will be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We are also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching. Keep your emotions in check, and I'll see you in the next analysis.